Hello, MEF members, as well as guests who are attending this webinar this morning. I am Paul Ruppert, an advisor to the Mobile Ecosystem Forum for North America. And we are pleased, and I'm very pleased and privileged to have Frank Lavin as a guest today discussing a timely topic of trade and its ripple effects on the telecommunications industry. Frank, welcome.
Thanks, Paul. It's a delight to be here. I always enjoy chatting about trade. I've spent most of my professional life in trade negotiations or trade policy or on the business side of trade, meaning I worked for Citibank and Bank of America and then a Singapore bank, all international trade side. So both the practitioners and the policy side, I've got a lot of respect for, and thank you for having me on.
Well, like I said, we're very privileged to have you because we've got you for about 30 minutes today with some Q&A afterwards. But you are the king of the 3-minute appearance on various types of cable channel news networks, including CNBC as well as China News Asia recently. Yeah. So let me just give the audience some detailed formalities of your background.
Sure.
Frank Lavin is a visiting fellow at the Hoover Institution at Stanford University. Relevant to our conversation today, which he's already alluded to, he's the former Undersecretary for International Trade in the U.S. Commerce Department in the George W. Bush administration. He is also the former ambassador to Singapore, where he negotiated the U.S.-Singapore Free Trade Agreement. In the private sector, Frank has served as a senior finance and leadership roles for Bank of America and Citibank. And in addition, he was early in his career a National Security Council staffer to President Ronald Reagan. So again, Frank, thank you very much for sharing your time with us today. What I'm going to do in the format of the session is essentially going to be setting up facts and laying out some conditions that we're going to be talking about afterwards in a conversational manner. And I hope the audience is riveted by a very potentially dry conversation that I know you can make very approachable and understandable across a number of different nationalities that are represented by the Mobile Ecosystem Forum. So it's no doubt been a hectic month for a trade expert such as yourself, but let me briefly set the stage for our conversation. April 2nd, President Trump declared Liberation Day, announcing a 10% universal tariff on all imports and an additional 34% reciprocal tariff on Chinese goods, effectively raising tariffs on Chinese imports to 54%, and that was on April 2nd. 2 days later, the administration raised tariffs on Chinese imports to 125%, citing China's retaliatory measures. 4 days later, on April 8th, tariffs on Chinese goods were further raised to 145%, incorporating a 20% surcharge related to the fentanyl crisis. April 11th, the White House clarified that the cumulative tariffs on certain Chinese goods could reach up to 245%. Yesterday, April 23rd, in response to market volatility and economic concerns about the president's comments relating to the Federal Reserve Chairman, President Trump announced plans to, quote, substantially reduce tariffs on Chinese goods, though he emphasized they, quote, won't be zero. I state that because over the last month, overall market value of the New York Stock Exchange listed companies has shed $6.6 trillion. In fact, up until last month, its 128-year history, there were only 7 times the Dow Jones Index had a single-day 1,000-day drop. There have been 4 more in the last 3 weeks alone. So the economy, mostly the U.S. and partially the global economy, has been shaken up like a snow globe in the last 3 weeks. And we're now settling into what the current conditions are and what it might look like going forward. So from your perspective, in a macroeconomic and policy perspective, how would you characterize current state of U.S. trade policy, Frank?
I think there's been an enormous shift under Trump, although, as you know, there's also been a bit of a recalibration. But the enormous shift is, with the exception almost exclusively with Trump, that there has always been an undercurrent in the U.S. and the general population that has qualms about trade or is unsympathetic to trade and views the dislocation or the job security element of trade as less appealing than the economic gains of trade. But that was always a minority view. And when we had consistency in leadership, was some kind of tilt toward trade, although different presidents had a different appetite for when to push it, how aggressive. But in general, the trend was incremental liberalization. Originally in the 1950s, 1960s, 1970s, through GATT rounds, as the GATT grew and as the WTO replaced the GATT, it just became more practical to work through bilateral FTAs, sometimes some regional groupings. And those were generally viewed as pretty successful. It really changed, and it changed over the last 10 years, I would say, with Trump being the most pronounced and most public hostile. But Obama, I think, was the first president in the modern era not to close or finish a trade deal. We had the Trans-Pacific Partnership on the table, U.S. aligned with 11 different Asian nations in a free trade agreement, including Japan and Southeast Asia. And Obama did not bring that to closure. Trump then repudiated it and said it was actually a bad idea. So Obama didn't close it, but at least he was rhetorically or philosophically in favor of it. Trump repudiated it, and then Biden's trade representative said we're not doing any more trade deals because they are. It was sort of a left of center critique. It was they have a distribution effect and they hurt working people, and so we're going to stand still. So for Biden's 4-year period, there's no movement on trade. Trump comes in and he's openly hostile. Biden is saying I don't have any appetite for more trade movement because I think there's a distribution effect. And Trump is saying trade is bad. Trade is harmful to the U.S. economy. We are being cheated. We're being abused, and we need to fix this. And it goes very aggressively, as you just delineated, Paul, with a number of tariffs applied against, I think, every one of our trading partners, including some very small territories that do very little with it.
Uninhabited islands, yes.
Uninhabited. Well, but even, I got a call from the Sri Lankan Foreign Ministry. So they said, we do almost no trade with the U.S. Every single part of trade we do is within the rules. We've never received any complaint or communication from the U.S. that we are not observing the rules of trade and all of our treaty obligations. And then we're hit with tariffs. So we, in our view, we haven't done anything wrong, and we're being punished. What is your advice? So even very small, very remote countries that are really consequential are being hit with these tariffs. And as you point out, the markets reacted as you would expect. There's a huge disruption to global trade. There's going to be response from all the trading partners. So this is just the first order effect is the U.S. being hostile to trade. Second order effect is a response from trading partners. And then there's enormous pause. That part of that second order effect is not just disruption of current economic activity, but anybody who is planning expansion, capital expenditures, building out warehouse, building out new processing facilities in anticipation of growth in a new market, everybody's got to freeze that activity because there's no clarity. And some of these are long dated. I mean, a warehouse might be reasonably inexpensive and might not be that risky, but a processing facility, if you said it's better off if we do some chemical production in Brazil than in our home market, that might make perfect economic sense. But boy, if it's $100 million, $200 million facility, you say we better hold off on that. So you get a real pullback in economic activity growth. So then it becomes self-fulfilling, that the cycle feeds on itself. And that's kind of where we are. And I think that's sort of what pushed President Trump to retreat, if you will, from his original pronouncements. And I think there's still more retreats that are going to take place, but at least he's moved off the bottom, if you will, to a less harmful position, and the markets have responded a little bit. But boy, it is harmful economically, and I think there's also a political residue that is going to have quite a half-life. It's not going to.
We'll get to that a little bit later. Yes, the political residue. Is it fair to say that then, given your experience in international finance, and combined with my experience in terms of on the ground selling on an international basis, that we're going to be falling into an uncertainty economy, which is essentially driven by risk-focused strategies, meaning let's do nothing and wait and see?
Yes, I absolutely think that's the case, Paul. And it's going to be segmented because some market segments, as I indicated, are more capital intensive and require more long-term planning. Others, say consumer goods, might be more what we call a depot business. All you're doing is shipping the product in and getting money back. So that's a little less vulnerable than these kind of swings. There's still a tariff effect. You still might find the toothpaste you've been selling for $3 a tube is now $5 a tube. So you might have to deal with a drop in demand, but at least there's not a risk to that, because all you're doing is shipping and collecting funds from it. But boy, anything in the industry is on pause.
So anybody who's involved in the large logistical trade mechanisms, when you see these freighters roll into the Baltimore harbor and they have 10,000 containers on their ships, what are they doing on a day-to-day basis right now in terms of processing paperwork? And even in terms of, okay, I'm inbound from, let's say, Shanghai, and I'm looking at a bill potentially of a 245% increase in terms of being able to receive the goods. And if they don't receive the goods, what happens? Is there going to be abandonment of supply or abandonment of the products, and therefore going to be affecting supply?
I think the more agile companies, most of the larger companies have strategic planning departments. They even have an in-house economist, and they're processing all of this real time. But that's the top 1,000 or top 2,000 companies.
Yeah,
right?
Exactly.
So, but you could be a reasonably small manufacturer in China, and you produce parts for bicycles. So it might be $100 million business, and that's fine. You're doing okay, but you've got no strategic planning department. You're just getting orders in email, and you've been supplying, 6 different customers monthly, and you've been doing this for 10 years. And I think that fellow is a laggard, and that fellow's waking up to all this bad news and dialing down. What part of your operations are flexible enough that you can dial them down and you can scale down, and what percent are you just sunk because you've got fixed cost or fixed debt in front of you, and you are really going to feel some pain. So those people in the first category are going to be able to adjust down and say, for the near term, we really can't supply the U.S. market. Demand there's going to collapse, but we can continue our domestic sales and domestic activity, and we're going to have to let 10% of our workforce go, but we're still in business.
Yeah, and they're probably looking to the equivalent of like a same day loans, same day payday loans. Like people who are at the lower end of the economy in the context of, I need money now, not tomorrow or not next week. I need money now. So they're going to their bankers, making these pleas, right?
Yeah, look, there's going to be people who are caught up in this bad news. The people who are over leveraged and really had a vision that was pretty optimistic and said, there's nothing but good news ahead in my bicycle market. It's growing 20% a year in the U.S. because we're the best supplier of bicycle gears or whatever. And you say that's not a bad production, but whatever projection, but whatever you do, don't bet the farm on that. Don't bet anything you've got. And if somebody bet the farm on that, they're really in trouble. They've taken on all the debt they could to scale up production, and now the market's collapsed. I'll give you a little good news, if I might, which is to say, I think there's significantly a return to normal in the coming months, probably with the exception of China. There's still I think, political utility in Trump having these tariffs on China. There's no economic value in doing it, but there's political value in doing it. And the paradox is, Paul, the more that he removes tariffs from other parties, if a trade war with the EU does not break out, for example, they get to some equilibrium, the easier it is for the U.S. economy to sustain the tariffs on China. It's still disruptive. It's still harmful to the U.S. economy, but you can sustain a smaller anomaly than you can the larger anomaly.
Yeah, is it possible to have essentially a trade strategy that is about design without disruption? And what I mean by that is, I'm going to concede to that maybe the president's got an idea here, and that he's onto something, that we don't have a coherent trade strategy. Yeah. And his only instinct, because of his beliefs, such as they are, is that it's better to be disruptive in tactical destruction as opposed to a strategic plan. And what I'm thinking is that, could there be a good by good, meaning material by material, product by product compromise, which then that framework could be benefiting potentially telecommunications services. It could be benefiting another, going to be those that we protect some industries, we open trade for others, and we bargain from a position of informed strength instead of reactive ideology. Is that feasible?
Well, I think it is feasible, but I think you're right that it's not Trump's philosophy. His view is, friction is a management tool. And if I can use friction and I can use this animosity, and some people will move, which, by the way, depending on the stakes and depending who you're talking with, there's probably a lot of validity to that. I would also say there's a lot of cost to this as well. That's why most of us don't go through life with our colleagues or our professional associations and use friction. We try to establish a common ground and parameters and look for ways to improve the relationship, but we don't begin by saying all of you are sinners and all of you are cheating us. It's almost a sort of Marxist interpretation of economics. I think according to Trump, there's more or less not one element of market economics which is sort of good faith or mutually beneficial. Every single transaction globally is only designed to hurt the United States, and all we're doing is pushing back against that. So sort of a universal condemnation of every other economy in the world, which, as we observed, isn't really sustainable. If he had been selective, we would pick maybe the most egregious cases where his comments are more valid, and then he'd have greater support and less economic disruption. The other point that's really missing, all other presidents observe this, the stick, so to speak, we talk about carrot stick, the stick might always be part of your trade policy, but make sure you lead with the carrot. And make sure in the macroeconomic indicators, if you're putting economic pressure or dislocation on another country, make sure you're doing more on the carrot side, that you're actually improving terms globally, so the U.S. economy doesn't suffer. And we would tell presidents in general, lead with that carrot. There are a number of countries out there that want to liberalize or want to work with the U.S. on another free trade agreement or some other kind of sectoral liberalization, as you indicated. And why don't you start with that, start to generate good news and get as much growth in the economy that you can from good news. And if you occasionally have to use the stick because there's malfeasance, countervailing duty or anti-dumping activity, that China's being bad on steel or Japan's being bad, so to speak, on cars, well, you can do that. But that ought to be a light touch. That ought to be the background music, so to speak. And that's not really your trade agenda, is not friction. Your trade agenda is how do we liberalize and how do we establish a mutually beneficial parameter here.
Okay. So I love you use the term friction. So I want to move from trade friction to essentially what I would call network fabric. What I mean by that is how this is impacting the telecommunications segment overall at the moment. At first glance, I haven't seen anything in the media relative to how this might be affecting telecommunications, but the reality is that some might assume that telecommunications, because it is a digital service, sits above the fray of tariffs and trade turbulence. And that's just not the case. You mentioned earlier first order effects. Well, there are second order effects that are already present in the telecommunications industry. All you have to do is just look at travel sector indicators. The U.S. Commerce Department data shows there's been a sharp drop in inbound international passengers as compared to last year at this time. Specifically, we're down 36% from Canada by air, 71% down by auto. Again, by air, we're down 21% from the UK, 25% from Spain, 33% from Germany. So what that translates into, these are real people not coming into the US anymore. In telecoms terms, from my perspective, being a former international roaming director, that translates into fewer international roamers, obviously, fewer very high margin voice minutes, less enterprise SMS messaging, and even lower two-factor authentication traffic from app logins. So we're seeing these impacts ripple through the international networks. They're just not being reported yet, given the recency of the drop in travel. And if we take this even one step lower, because as you mentioned, there's this 245% tariff on rare earth imports that come from China. And they are critical elements for virtually every mobile handset in circulation. Now, so that's not necessarily a policy lever anymore. That's just a shockwave to the supply chain in mobile telecommunications. And I know that the president is trying to develop opportunities for various types of mining and other types of manufacturing opportunities in the U.S. But the reality is, as you very well know, because of your experience in China, that the Chinese process about 90% of the world's total supply of rare earths. And the U.S. only has one single rare earth mine. Meanwhile, in China, there are vast numbers of processors and mines that produce rare earths. What does that translate into? Well, an Apple iPhone alone contains more than 17 rare earth elements. So with this kind of structural dependence, how do we navigate this tension between wanting tech independence and avoiding the cost vis-a-vis an adversary who may not be responding exactly as we wish they would, meaning China.
Sure. And let me add, if I may, Paul, to your list. I thought it was a very good list. There are going to be some big CapEx items in there too. Somebody says, I'm doing this kind of coverage right now, but my market is growing nicely. I need to improve the coverage. I need to go to 5G. I need to do other things. But these are big ticket items. These are big checks you've got to write. And it's done on speculation that the market is going to continue to grow at 20% a year for 5G. Therefore, I don't mind spending $1 billion. I don't mind participating in a satellite launch because this all is on a great trajectory. Now the risk factor comes in. Maybe it's not a great trajectory. What if growth, instead of projected 20% annual growth, is only 14% annual growth because of these complications you raised, to say, boy, let's push back the satellite launch a year or two till we have more clarity. So I think you're going to have more of a freeze or a pause in a lot of these major upgrades, major CapEx activities, because there's just uncertainty in the market. So it becomes a self-fulfilling prophecy.
Yes, in your explanation, you also touched upon 5G. There too, this is a roll through. 5G has been out there in terms of the implementation, and as in all types of shifts in technology in the telecommunications segment, there is a wave, there is a time frame in which it is adopted across the overall marketplace from 2, 3, 3G, 4G, 5G, and hopefully 6G. The reality is, because of all this, there's going to be more friction, slower adoption, and everything else that ripples through, including innovation development as well as investment, right?
Right. I think you're absolutely right. Look, the good news in this picture is that telecom industry is fundamentally on the right side of the consumer base and the business logic. So there's a very powerful economic logic behind what the telecom industry is doing, that the customers want it and need it and use it, and it helps them do their job better or have better lives. So that overwhelming demand side logic still exists. What's complicated now is the expense and lack of certainty on the supply side. It's going to cost maybe more, or we have less predictability in imports, or there's all sorts of other bumps in the road that we didn't have before. So what we would normally do in terms of rollouts and expansions, we're just going to slow it down or pause until we get a little more clarity. So I think it's a terrible outcome for all of us.
Yeah.
It's not a deal killer. The logic still exists, the demand still exists, but it just pushes back or slows down what would happen normally.
Yeah. So tell me, given where you've been on point, relative to all the things that you've done negotiating these various types of trade agreements in the past and promoting the exports of the United States of America, if you will, that's a heavy burden there, Frank, I have to say. What I'm really leading up to is what's going on behind the curtain, behind the door, so to speak. When I used to have to carry bags and paper, if you will, for guys like yourself,
yeah.
What's going on in terms of the conversations? You just mentioned that the foreign ministry of Sri Lanka gave you a ring, and trying to figure out, what do we do next?
Right. Well, I think in Washington, the current administration, President Trump is running the most personality-driven decision process that I've seen. Everybody else had some kind of cabinet input or technical input or chief economist input. Everybody else had some kind of internal consultative mechanism. Whereas you'd say every policy decision on trade or any activity has trade-offs. There's some kind of cost, some kind of benefit. Who are we really helping? Who are we really hurting? What are we really trying to do here? And that's why you have a consultative mechanism to help you think through these trade-offs. Trump is overwhelmingly driven by his own impulse. And look, just think for a second about the 4 reasons he articulated as to rationale for what he's doing on trade, because they are significantly contradictory reasons. That you'd say, well, all 4 of these cannot be true. So he said at one point, we're doing this because of tariff levels aren't even, and we need reciprocity in tariffs, which, by the way, is a reasonable goal to my mind, but we sort of have that on the table with free trade agreements. So we had that implemented free trade agreements, and he attached tariffs to our current free trade agreement partners, to Canada, Mexico, Korea, Singapore, Israel, Australia. So even places that were basically what we call 0 for 0, free trade is as good as you're going to get. He said, I don't like you. So his first point was no reciprocity, and that's a sin, and we're going to get you for that. The second point was balance of trade, that if somebody's selling more to us than we're selling to them, that's wrong, that's an evil, and we need to push back against it. I'll tell you, that is has very little support among economists, that there's nothing intrinsically wrong with one country having greater exports to the U.S. than the U.S. had. And again, the smaller countries are going to say, if you're Jamaica, you're going to say, look, we don't have the resources to buy. There's only so many U.S. cars we're going to buy.
Exactly. Right.
So
it's like Switzerland, 8 million people, and there's a massive trade imbalance, and it's mostly because of pharmaceuticals and watches. Of all things. So
no other economist had viewed that as intrinsically bad or wrong or harmful or a basis for any kind of trade action. It might reflect some kind of anomaly. It might just be market preference. And by the way, that second point is contradictory to the first point, meaning if you do have free trade or have no tariffs or no trade barriers at all, somebody is going to sell more than somebody else in a perfectly free market. It's sort of saying, I want everybody in the basketball league to play by the same rules, and I don't want anybody to score more goals than anybody else. Well, one of those is going to, if it's perfectly fair rules, somebody's going to win the basketball game. But again, we've never viewed that historically as bad or harmful.
Right.
The third point he made is it's going to get us revenue. It's going to get us revenue because we're going to have tariffs and our revenue is going to go up. We said, boy, his history shows us that is a self-negating thesis, because it hurts the U.S. economy that is imposing these tariffs, so our overall economic performance drops. And the imports themselves aren't static because they're now more expensive, so the consumers have less demand for them. So that inevitably falls short or completely eliminates any revenue benefit. And his fourth point is reshoring. We're going to get all these industry jobs back to the U.S. because of this. To say, well, if reshoring is true, then tariffs certainly aren't true, because you're taking tariffs down to zero, taking tariff revenue down to zero, because you're brought all the jobs back. So look, Trump is not a stupid guy, but when somebody offers or puts forward these four somewhat contradictory or largely contradictory impulses, I think that tells you that tariff policy, trade policy is not what's driving his behavior. What's driving his behavior is sort of the seduction of friction, that he likes the turmoil, he likes being in the news, he likes being center stage, and he knows some countries and some economies will be defiant and say, you can't do this to us, and we reject it, and we're going to put on the same tariffs. And other smaller economies will just go along and say, okay, you're right. We'll renegotiate or we'll do something. So he's going to get some positive response from what he's doing, so to speak. My only point is that positive response is vastly outweighed by the negative response he's going to get, that he's hurting our overall economy, even if Jamaica says, tell me what I need to do to be your friend, and I'll try to do it. So he's going to get people like that, which stands to reason, but it's going to hurt the U.S. economy regardless.
Yeah, so we're getting close to the end of our discussion, but I wanted to raise one last thing that I've kind of held back from the audience. In your past, you were also the Director of Political Affairs to President Reagan. You were the senior most White House advisor to President Reagan on political activities. So what are the politics that we're going to be seeing involved in this? When I used to be trained by guys that like yourselves in the context of coalition development, there's no coalition development that's going on. This is a binary black and white perspective in terms of how he sees the world. But we also see that the approval ratings that have come up in the last 2 to 3 weeks are just tanking, well beyond anything that we would ever thought are survivable by a political operative or a political candidate.
Well, my interpretation of this, Paul, as to your point, is the beneficiary of trade for the U.S. economy or anybody's economy, the benefits of trade vastly exceed the cost of trade. But in a static situation, in a neutral situation, the voices of those who absorb the cost of trade, it can be louder than those who get the benefits. So you have disgruntled constituencies, unhappy people have been dislocated, or just grievance plays a role in political debate. Even if someone has not been really hurt by trade, they subscribe to a grievance theory of economics that some people are benefiting, some people are being hurt, and we need to push back against that. That's very much Trump's mindset, is organizing around grievances. So, for example, the use of steel in the U.S. economy, the unit of steel consumption per unit of GDP has been in decline for over 70 years. That we just need less steel, we use less steel because
higher productivity, et cetera. Right.
You've got carbon fiber, you've got polymers, and steel is great, but it is heavy. So we know what's going to happen in the next 10 years. Are U.S. auto manufacturers going to use less steel per unit of car or more steel? They're going to do anything they can to take the steel out of their car, and they're going to be incrementally successful. So you have a huge group of historic legacy employees and firms and operators of steel adjacent industries who are unhappy. Now, all this has little directly to do with trade. Trade accelerates this process, but it's a secular phenomenon. But Trump is speaking to that sort of undercurrent of
That cohort, right?
and unhappiness and so forth. Right? And he plays that very skillfully. And I'd say when it's latent, everybody likes to complain, or there's a segment that likes to complain. It's cost-free to complain. Then when you actually change and follow those complaints, you say, by God, we have many more people benefiting from trade than were hurt by trade. Right. What are you doing? What are you doing listening to the complaints? You're just listening to the angriest, most unhappiest group in the U.S., some steel workers or legacy steel workers, and you're organizing your whole national policy on the basis of nostalgia or emotions or psychology. You're not organizing your economy on the basis of the future. What are the 10 fastest growing industries in the world, and how can we capture as much of that as we can? Right? So it's a very odd way to focus on the economy.
Yeah. So is there any glimmer of hope in this conversation in the context of, can we extract some innovation instead of the friction that we were foreseeing on the immediate side? And I have to say that 3 weeks ago, when I started thinking about this, I saw one of your appearances. You were essentially saying we need to wait and see. Well, you were prescient. 3 weeks later, he's essentially adjusting his position, radically adjusting his position. So what's the glimmer of hope and light just over the horizon?
I do think the stock market plays an important role. I do think the bond market, those were really flashing red lights. You're going the wrong way. But also, as we were talking a minute ago, all of these industries that are integrated into a global supply chain or provide services for that global supply chain are saying, wait a second, we've got our entire auto production industry depends on sourcing from around the world and getting the best components we can. And that's how we make the cars we make. And if you disrupt that, you're not bringing jobs back. You're not helping U.S. autos sell, and you're closing off our own export markets. And there are segments of our economy, Paul, like agriculture and service industry, including telecom, were huge international suppliers and huge beneficiaries for that international marketplace. You're putting that at risk. I would just encourage anybody, whether you're from Europe or India or the U.S., to try to get your game up, if you will, in Washington, to make sure that the policy rationalists there understand the important role that this international connectivity plays in the telecom space.
Okay, excellent. So we do have 2 questions from the audience. I'm going to take the first from James Lasbury, who I know very well. And his question is, it would be great to understand your view, Frank, of the impact on innovation and M&A, specifically in telecommunications. We kind of touched upon the innovation slowing down and lagging because of just the general friction in the environment, but why don't you pick it up from there?
Yeah, I think that's the fundamental point, that I think some R&D is long dated, and to say we want to be active in this space because we don't know what's around the corner, but most R&D, I dare say, is short dated. We're working on a series of pharmaceutical products or telecom products or automotive products because we think in the next 2 or 3 years we can bring stuff to market. And we're sort of, it's not quite a bet, but there's sort of a risk profile there that says we don't mind spending $1 billion a year on R&D because we can take to market and make $2 billion out of this. That's our goal. And now that's all attenuated. That's all put at risk. By the way, I think M&A is put at risk as well because you're not quite sure what you're buying or what you're selling.
Exactly. The economy of uncertainty.
It's an economy of uncertainty, and it really depends on the risk appetite and liquidity of the acquirer. If you say in normal terms, this target acquisition would be worth $1 billion, boy, by normal metrics today, it's only worth $800 million. But they're not going to sell for $800 million because in their heart, they say we've got $1 billion company. But there might be somebody in that pool, somebody with those kind of characteristics that say, yeah, I think we are worth $1 billion, but we've got other kind of problems or goals or concerns. And so we don't mind selling at a discount because ready money right now has value for us. And we don't want to wait on a bet that is all recovered in 2 or 3 years and wait 2 or 3 years. So the companies that have a risk appetite say, we're so liquid, we don't mind taking a bet that if we can get this $1 billion company for $900 million, we think that's a heck of a good bet. And there'll be companies in that space.
Right. Okay. So there is a glimmer of hope. just over time. Wait and see, as you pointed out. So one last thing, I'm going to take a page out of your playbook. What two books would you recommend for our audience to pick up on trade? And I'll do the same.
Well, there are a lot of great sort of history of economics books.
Keep it approachable, Frank. We got your books, yes.
But I mean, below that, I've got some other books because I like, the history of economics and the history of trade, and it really starts sort of in the European Middle Age. I mean, the Babylonians did it, and the Egyptians, other societies did it. But if you start looking at the emergence of a merchant class, and I'm thinking of Broidle's History of Europe, of medieval Europe, because he makes a very interesting point. If you're on a coast, if you're in a port, your society is based around trade. And again, the Egyptians, the Romans, other folks did this. But if you're a shoemaker in medieval Frankfurt, your entire customer base and your entire supply base is in your neighborhood, is no more than a few miles away. And what Broidle said the Middle Ages brought us was the first time you had a merchant class of people who would never personally know or see their customer. And this is the first time in the history this happened in Europe. And you needed laws to make this happen. You needed the standard currency to make this happen. You needed standard measurements, units of measurement to make this happen. So you need some kind of architecture that would allow trade to take place. But they said that this is what the Middle Ages were all about. They standardized all of these rules, and then you could flourish. You had the beginning of prosperity, and the rates of growth started bubbling up that set the stage for the Industrial Revolution. So Broidle's book, Braudel, and I honestly just cannot recall the title of the book. I would recommend that.
So I got one for you,
okay,
which is essentially a splendid exchange. I think I've got that up here.
Yeah.
Much like you described, but this was a book in 2008 by the Economist recommended it as the best business book in 2008.
That's great.
So it essentially covers prehistoric origins to different crises in trade, much like we are discussing today. Even though it's old, still applicable. So in closing, Frank, where can our audience learn more about what Frank's perspective is on a day-to-day basis on trade or month-to-month basis on trade, and how can they communicate with you if they're interested?
Well, I'd be delighted. As you can tell, I enjoy talking about trade. I love trying to follow the domestic politics of this, and we're all a bit of Trump watchers now, Trump whisperers now. I'm on LinkedIn as Frank Lavin. I'd be delighted to connect with anybody. I do write regularly for Forbes. So you're welcome to look there, and I'll post this sporadically on social media. And may I go back to your question, because you shamed me.
Of course.
Calling. It's Fernand Broidle, and his book was Civilization and Capitalism, the 15th to the 18th Century, the structure of everyday life. So how did the evolution of trade allow just the everyday member of the linen weavers guild to go ahead and have a better life, because now he can sell his linen. So it was really a transformational moment for humanity, driven by trade.
Indeed. Great note to end on. Again, thank you so much for your time, Frank. I very much appreciate it. Always appreciate the fact that I get the chance to talk to you periodically. So,
it's been a delight. I love Jack. And by the way, it's therapeutic, and all this bad weather, it's therapeutic to reconnect with an old friend and to have these kind of broader discussions. And I am always sort of an optimist. U.S. has really taken a negative turn in the last 2 weeks. But over the long run, rationalism tends to prevail.
Well, I may come back to you. We could do another show for just on China, given your depth of experience, the fact that I live there and did business there. It would be a great opportunity to explore that further.
I would welcome that. I'd welcome that, Paul. Whenever you're ready, that'd be great.
Okay, sounds good. Thank you all.